Hello, I'm Tanya Hamilton, and we also have Kelly Pocock here from Urban Haven Group. And
Hello.
today we are hosting Ryan Iannone, and he is here to talk about Purchase Plus mortgages. He also previously did a webinar with us on alternative lending, which I will post a link to in this video. So if you are interested or self-employed or have other requirements, alternative lending can be great. And we talked all about it in that other webinar. So definitely check that out. But Ryan, off to you to chat Purchase Plus.
Okay, thank you very much. So I'll just go through. First slide here. My name is Ryan Iannone with your Mortgage Guru team over at Mortgage Connection. Here's my info if you need any info. So I'm a partner mortgage broker, been doing this for over 20 years. The only thing I've ever done is mortgages, so have a pretty wide range of experience in this world. And I want to thank you guys for having me on here as always. I always love sharing info and educating. So it's one of my favorite things to do for sure. This is what we're going to talk about. Is called a product called Purchase Plus Improvements. It's how to turn the almost perfect home into the perfect home. How do you make those little changes to your house that you need to make and include them in your mortgage? There's lots of ways you can look at this. My opinion, this product is one of the best products in the industry and probably the least used, unfortunately. People don't know that it's out there. I can honestly tell you there's mortgage people out there that don't know that this is a product. So this is something that can get you into your home and make it more your home versus a place that you're buying. So as we go through, please ask questions. Tanya, as last time, let's have lots of questions and have a little bit of a conversation here if you're not sure about something or have more questions about something. So what is a Purchase Plus improvement? So this product allows purchasers to buy a home and make improvements to it after taking possession. So you want to buy that home. You want the improvements. So let's say it's a fairly decent improvements, 20 grand. You want to be able to include that into your mortgage. You don't want to put all of that up front and have 20 grand of your savings gone, or a loan or a personal line of credit. You want to include that in the mortgage. That's what this product is for. Basically, it turns butts into your dream home. So I love this house, but this house is in the perfect area, but all of those buts can be fixed with a Purchase Plus improvements. It's a very specific product on how we have to do it, and we're going to go through all of that here in a second. So the types of renovations that you can do. So what can we do? We can do basement developments. We can do garages, kitchens, flooring, roofs, house systems, windows, doors, legalizing suites. We can upgrade the electrical service, and we can remove poly B. So basically anything that is adding value to the property, we can do. Painting is a new one, but we all know that you can do painting. It was something that wasn't allowed about 10 years ago. Now they're allowing it because we actually know that it is the biggest return on your investment that you can do to a property is painting. So they're allowing that now. What can't you do? We can't do appliances, basically because an appliance can be picked up and walked out the house. So they don't want that. Structural work, they won't allow structural work because if there is major structural issues, the lender's probably not going to give you a mortgage on day one anyway. So we can't really do it as a Purchase Plus. And remediated grow-ups. Remediated grow-ups, even if you have a house that was torn right down to the studs, restarted, rebuilt, if the lender knows that it used to be a grow-up, we have no lenders on our side that will even touch that house. It could have been 30 years ago. They won't do it. So remediated grow-ups are a no for purchase, period. Yes.
How are they for just regular standard mortgages these days?
Grow-ups?
Yeah.
They're a hard no. And that's why you can't do a Purchase Plus improvements on them, because they literally every once in a while a lender will come out and say, yeah, we're doing these on exception. Right now I don't have a lender that will even touch them.
Okay, not even if it's like 20% or anything.
5%, 90%, 50%, fully rebuilt 20 years ago. If they do their digging and they find out that it was a grow up 20 years ago, it's a hard no.
Wow. Interesting.
Yeah. So there's two reasons being is number one, sidebar here, but number one is the stigma that comes with it, right? So if down the road, every lender, but when they do a mortgage, they look at the property that the mortgage is going on and they look at it and say, we're going to own this property. This person's going to default on this mortgage. We're going to own this property. How quickly can we sell it? And are we going to get our money back? That's their number one concern on every single one, every house that they do. A remediated grow up, even if it's been fully remediated and everything is fine now, the concern is that if there's 100 people that want to buy that property, maybe 50 of them don't want to buy that property anymore just because of the stigma of it being a former grow up. So they will remove that from the equation and say, we just don't want these because we don't want the hassle of what can come down the road for resale value, stigma of the property, all of that stuff becomes an issue. Okay. So we don't touch them. We have no lenders that want anything to do with them right now.
And now, sidebar again, for us as realtors, is there any place that we would be able to look up and see whether or not a house is a grow up before a client makes a purchase?
So I am told that Manulife will look at a remediated grow up, but only through their financial advisor channel. So we have access to Manulife, but through their mortgage broker channel, where they have their main channel is through financial advisors. So if you go through that channel, I've heard that they will look at remediated grow ups. I've heard from time to time that CIBC branch level will open up their doors and will allow former grow up, stuff like that. So I think it's a case by case, and you kind of have to shop around directly with lenders to see what they'll do. Okay. All right. Okay, so when it comes to purchase plus improvements, there are some general guidelines that we have to follow. So this is what we're looking at pretty much on every single purchase plus improvements that we have. So the buyer can apply for up to 10% of the initial property value to a maximum of $40,000. So if their current house is $500,000, the 10% would be 50, but the general guideline is we'd be stuck at 40. Okay, so that is general guideline. Improvements can exceed $40,000 if supported by the insurer or the lender. So we have seen ones upwards of $100,000. I think the biggest one I've ever heard was like $198,000 purchase plus improvements. That's on a big exception. That's with a specific lender that's allowing this to happen. The lender is saying we're okay with it. The insurer is saying they're okay with it. So they make an exception and they'll allow it to go that high. Typically, it's going to be very house specific. So if someone buys a $400,000 house and they come to us and say, we want to do $100,000 of renos to this property, 25% of the value of the house is pretty significant. There's obviously bigger issues than just, improving the value of the home, versus if someone buys $1 million or $1.5 million property and they come to us and say, hey, we need to do $100,000 of improvements to the house. That makes more sense. We're more likely to get an exception on that. The work that gets done on a purchase plus improvements must be done by a qualified contractor. So we used to be able to get a person buys a house, they used to be able to do the work themselves. Lenders are requiring qualified contractors to do the work. Even flooring, painting, we might get away with, but even then what was happening is they're finding the quality of the work was not up to standard. So they're giving them $10,000 of value for the work, but realistically, because the homeowner did the work, it's only worth half of that. So qualified contractor has to be a part of it. If the homeowner is an electrician and they're a qualified licensed electrician and the improvements is going to be electrical, we can do that. They can do that themselves, but they have to be qualified. They would not get, they would only get value for basically the cost of the goods or whatever they had to purchase. They do not get paid for their time. Okay, so we can't get purchase plus improvements for their time.
Lenders really don't like using mortgage funds to put it in buyers' pockets.
No, they hate it. Yeah, they hate it for sure. So yeah, we want to see qualified buyer or qualified contractors for sure. We can basically go up to about 180 days now. So definitely if there is going to be seasonal work, so if someone's doing a garage and we closed the mortgage in December. And we obviously know that there's, building a garage December, January, February in Calgary is not really a thing. So they will give more leeway for seasonal stuff, but you can go up to about 180 days. It is lender specific for sure, but they do give you time to get this work done. Any change to the quote needs to be reapproved. So if you are, if we get it all approved and you waive your financing, then you decide, okay, I don't want to do the floors anymore. I want to use my money for something else. We do have to take that back to the lender and the insurer to get their approval. Whatever we get approved. So if you say you're going to do your flooring, we have to do the flooring. You can't get approved for the improvements and then turn around and move into your house and then a week later decide that you're not going to do the floors and you want to do your bathroom. That's not how it works. They've already approved the floors and the value of the floors. So if there is a change, we definitely want to get that reapproved, and we want to do that before closing. Yes, Kelly.
So say someone decides they want to redo their floors, they've got the mortgage plus for the flooring, but then they decide they no longer wish to do the flooring anymore and they don't want to do any renovations.
Okay. And they've moved in?
And they've moved in. They decide, you know what, we'll accept the flooring. We'd rather not have that on our mortgage anymore. Can that be reversed?
Yeah. So basically when all of the money that for the improvements is given to the lawyer and the lawyer holds it in trust. So if the work doesn't get done, so let's say that they, in your scenario, they just decide we're not going to do this anymore. We can contact the lawyer, contact the lender and say, hey, they're not going to do the improvements anymore. The lender will instruct the lawyer to prepay the mortgage. So if there's $20,000 of money sitting there for the improvements and they decide not to move forward, the lawyer will take that 20 grand and put it back on the mortgage.
Okay.
So their mortgage will be cheaper. That's the same thing with 180 days. Once they've kind of figured it's been a long enough time to get the work done and it hasn't been done, the lender can come back and say, we're not waiting anymore. You're not doing the work. Our money's sitting there. The lawyer is going to make the prepayment.
Okay.
Okay. So that's kind of how it works. A couple of weird scenarios kind of while we're in this that we had a person, and I'm not kidding, this happened last year. Someone did a purchase plus improvements, and as mortgage brokers, we're not really involved a whole lot with the after funding part of it. So typically what happens is the client will do the work. We'll get a notification from them saying, hey, we've done our work. We want to fund our mortgage or fund the improvements. And then we deal with the lawyer and the lender to get the money released. We had a client that was 2 years after they took possession. And the weird thing was the lender had never requested the money. The lawyer still had the money in their trust. And they basically came back to us 2 years later and said, hey, we did the work. We want our money now. And first comment from the lender was, no, this has been way too long. But once we kind of dove into it and looked around, because the lawyer still had the money and it was still in trust, they actually let it go through. So there's the guidelines and there's the rules that they have, but in the end, in certain scenarios, they do bend those rules. Okay. We do have, so the next point is we do have some lenders that will do up to 3 draws for bigger projects. So let's say you're doing $100,000 reno on your property once you move in, and your contractor requires money in stages. You know, they can do $30,000 of the work, and then they need the money to kind of move on to the next stage. Similar to doing a new build with a lender that needs progress draws as well. This works the same way. So the contractor gets to a certain point. We get an inspection done on the property. The inspector comes back and says, yeah, everything looks good up to this point. And then we would get the lender to release X amount of money to the contractor, and then they can do the next one and the next one. So we do have a couple of lenders that will do that. Definitely not all will do that. Important note on the general guidelines is these mortgages have to be insured. So less than 20% down. But if you do put 20% down or more, it has to meet the insurer guidelines. So it has to be what's called insurable. So that means that you have to have 25-year amortization maximum. Your ratios have to be in line. So it basically has to fall within the insurer guidelines no matter what. Okay, so we can't do it on weird deals with stated incomes or higher amortizations or anything like that. It has to be an insured deal. Okay. All right.
Normal.
How does it work on our side? So the approval process is similar to getting a mortgage, a regular mortgage, but there's a couple other things that we need to do. So we do need, as soon as possible, the buyer to provide contractor quotes outlining improvements. So we need something in writing from a contractor or someone stating what the improvements are going to be and how much the cost is going to be. The costs are added to the purchase price and submitted for approval. So when we send it to the lender, simple numbers, we're $500,000 purchase price. We're going to do $25,000 of improvements. So the final price is going to be $525,000. What we're asking the lender to do and the insurer is approve the $500,000 purchase. Can we buy this property for $500,000? Is the value there for $500,000? Yes. Now, are you going to approve the extra $25,000 and the value of $525,000 after all is said and done? So that's what we're asking them to approve upfront. So that's what the next point is. Mortgage is approved based on an as is, so that's the 500, and then as if complete value, so that'd be the 525. So the insurer or appraiser is going to give us those two values. I can say from experience, very, very, very seldomly does it come back and they say, no, this value is not in the property. So I can't remember off the top of my head at a time that they've come back and said, no, you're asking for 10 grand of value to redo your kitchen, that they've come back and said no. So most times it is going to get approved. On closing day, all funds are advanced to the lawyer and improvement funds are held back. So the $500,000 is like $525,000 goes to the lawyer. The lawyer on closing date is going to deal with the 500 to make sure that the person buys the house. They're going to hold the 25 grand back. And then once the work is done, they're going to release the funds to the buyer or the contractor. You will have to get an appraisal company. So once you come back to us and say that the work is done, we have to get an inspection done by an appraiser. They're going to confirm the work is 100% complete, that it has been done up to the basically what the client said that they were going to do. The lender will review the inspection report and authorize the release of the holdback funds. The lawyer will distribute the funds to the contractor or client. So whoever the money needs to go to, the lawyer can release those funds. Okay. Something that is important to note about this. So when we talk about, we're going to get into it in a second here, but getting that initial quote, sometimes it's easiest. And I always tell people, if you don't have somebody ready to go and you don't have a contractor, because it can be hard to get a contractor to come do a quote in a very short when we have a condition of financing date. I will sometimes tell people just to go to Home Depot. If you go to Home Depot, let's say you have to, once again, you have to do a garage. Home Depot, in their computers, if you go there with the right measurements and tell them what you need to do, they can give you a quote in minutes with the cost of the garage, including labor. You don't have to use Home Depot to do it, but we have a quote. We have a number that we can use. Okay. Buyer requirements. So the buyer must qualify for the extra funds. So they do, once again, in my example, they do have to qualify for a $525,000 purchase. Provide time to quotes to meet financing conditions. So we can have different sources, or you can have the same source. So if you have a general contractor, they can give you a quote for everything, or you can have multiple quotes from different contractors depending on what you are able to get. That's where you could go to Home Depot. In my opinion, it's very fast. You have to ask access to additional down payment funds. So your down payment is going to be based on the as improved number, not the current purchase price. So if you want, once again, if you're buying for $500,000, but you're going to, the as improved value is going to be $525,000, we need the down payment for the $525,000. We need the ability to provide contractor with initial deposits. So if you're doing a bigger project or something like that, your contractor might require you to have an initial deposit to make sure that they're able to get the work going. You might want to get the client to confirm that the contractor can complete work in a timely manner in the time frame that we have. So if they're going to a very busy contractor and they're booking out, 6 to 12 months out, maybe they need to find a different contractor. All work must be 100% complete as per original quote. So once again, we need all the work done. And if they come in and say that they're going to do a bathroom, but they do their kitchen, that's an issue. Okay, we need them to do what's actually quoted. A couple of tips for a successful purchase plus improvement application. So manage the COF on purchase with quotes. So what do we mean by that is if you come to us, and this is for realtors and their buyers, if you come to us and say, we're going to do a purchase plus improvements, here's the offer to purchase, and we have 5 days for condition of financing, but we're not going to get a contractor until Thursday, but we have to waive on Friday, it's going to be really hard for us to get that purchase plus improvements. So you typically, I would say, ideally, if you're going to do this, do it. If you're going to give us 5 business days, make sure that you're getting a contractor or someone quoting you that day, kind of on Monday, if we have till Friday. If you're not going to get someone in for a few days, maybe you can ask for another 5 days for condition of financing, just so we have time to make sure that we get all our documents that we need. Add viewings as a term to the contract. So if you are, once again, it's a Monday, you're not going to get a contractor until Wednesday or Thursday, make sure that in your contract as a term that you're getting an additional viewing. Hey, I need to get a contractor in on Thursday. Make sure you have that in the contract so we can make sure that we get them in. And we also say keep the quote simple and the estimate on the high side. So the reason why we say keep the estimate on the high side is because once the mortgage is funded, there's no more money. So if we fund 525 and they gave us a low estimate or a low quote, and then they use someone that comes in 10 grand higher, we're not getting the extra 10 grand. But if they get that $25,000 estimate and they come back and it only costs 15 grand, we're okay. They won't get the full 25, they'll get the 15 back, and then the extra $10,000 will go on to back on the mortgage. But it's better to be on the high side for the quote, just because we don't want to be low and then come in higher on the actual. Okay. All right. So what are the benefits of a purchase plus improvement? So we can combat buyer obstacles during showing. So once again, this is the perfect house, but if you do home inspections, as I'm sure you guys can attest to this, home inspections and people coming back and saying, there are all these little things, or I just don't like this, I don't like this. Purchase plus improvements could be something that we could put out to buyers. Even if you're a selling agent, maybe put it out there. Hey, what about a purchase plus improvements to get this work done? That might get more houses turned over. Buyers can put a personal touch on the property, so this can make it a little bit more of a personalized home by being able to do the work after they move in. And then for everybody, and I think this is just a good thing for realtors, for buyers, and we can build personal relationships with contractors and renovators by having this product. Most big contractors, renovators know about the purchase plus improvements. They love it because they know all they have to do the work and they know the money's going to show up. So they are big on this. All right, so we'll go through a few examples just to show how we've used this in the past. House with an unfinished basement. So this was an insured mortgage. Original purchase was $700,000. So minimum down payment was $45,000. They had a monthly payment of $3,241. Purchase plus improvements mortgage. So we're going to get a quote of $45,000 for the basement. So the new price is $745,000. The adjusted down payment required is $49,500. So basically $4,500 more down payment to buy this property. And the monthly payment came in at $34.42. So basically they're paying $200 more per month, and they're adding $45,000 of value to the property and getting a finished basement at the same time. So it's pretty, monthly cost wise, pretty amazing how much it ends up costing you. And then with this, what's that?
That's not very much. That's only $2,400 a year.
Yeah. Yeah. For like, once again, and then you have a finished basement and you have a like $45,000 more value in your house as well. And for this one, interesting thing is, let's say you're going to do a legal suite. That's even better, because if we do have a lender that if you're going to do a legal suite or a conforming illegal suite, they will actually use 100% of the future rental income to help you qualify for your mortgage as well.
Amazing.
So even though it's not done, and it hasn't even been started, they will allow you to use rental income in the future because you are going to build a suite.
Wow.
And that's huge. So 100% rental income offset. You don't have to use property taxes for qualifying or heat. And it's a huge difference for qualifying.
Yeah.
Okay. All right. So that's number one. Number two. So this was a conventional mortgage, house with original kitchen and flooring. So purchase price was $600. 20% down payment was $120. So the monthly payment was $2,600. So we got a quote of $35,000 for a new price of $635. And then the adjusted down payment. So for an extra $7,000, they were able to get their new flooring, new kitchen, and their monthly payment went up to $2,752. So once again, based on this example, for an extra $152 per month, they were able to get their kitchen done. They were able to get their floors done. And the nice thing is when the appraiser went in and determined the new home value, it was actually $655. So that extra $35,000 and $152 per month actually increased their value by $55,000. So that was a win-win for the clients for sure. Example 3. So this was one of my favorite ones. So we had a house with a single detached garage changed to a double. So this was an insured mortgage, and the original price of the house was $550. So the minimum down payment was $30,000. The monthly payment was $2,573. We got a quote of $30,000 from the builder of the garage. New price $570. Oh, that's bad math. Should have been $580. Sorry, I'll fix that later. So $580 new price, adjusted down payment $32,000. So the monthly payment only goes up to $2,663. So for $90 more per month, they had their double garage and their value of the house went up about 30 grand. In this scenario, it was a little bit different. So the reason why I threw this one in here is because they didn't get full value of the property. And now that I think about that's why it says 570, is because they already had a single detached garage. When they bought the property, the 550 included the value of the single family detached garage. The $30,000 quote included the demolition of the single family detached garage and the building of the new one. So they only got $20,000 value from that quote of 30 grand because there was already value in the house for the single family detached home. But that being said, they now have a double detached garage and they only went up $90 per month. Okay. So why, I'm going to do a little self-promotion here. Why would you use a broker to do a purchase plus improvements? Because I think this is important. When in our world, you have your lenders and you have your insurers. And remember, this is an insured product. So every single time that you do a purchase plus improvements, it has to be either less than 20% down, so fully insured, or it has to be insurable. So the lender has to be able to insure it themselves with the 3 insurers. So they actually all have kind of their own rules, and they can do it however they want as a lender. So some lenders stick to the 10% or 40K no matter what. So if you're not dealing with a broker and you walk into your bank and your bank is following the guidelines of this rule exactly how they're put out by the insurer, then you are stuck at 10% or 40K. You have no way around that. That's how they're going to do it. Most lenders won't do draws. So if you're going into bigger purchase plus improvements, there's very few lenders that will do draws. And the required documents to confirm completed work are not always the same with all lenders. So as a broker, because we deal with dozens of lenders and we can place a buyer appropriately based on their specific improvement needs and budget. So if someone comes to us and says, I give that example before, if someone comes to us and says, I want to do a purchase plus improvements to build a legal basement suite, there's one lender that I'm going to no matter what, because I know that they will use that improved value and improved rental income from the basement suite to help these people qualify for the house. So it just is going to make that deal much stronger. They may be able to get into a bigger house, a bigger mortgage by doing that. If you're not dealing with a broker and you go to your bank's not doing that, and they don't know that. So we can use our dozens of lenders and all the lenders we have access to find a specific place based on every buyer's needs. So more options means more successful approvals. Okay, little self-promotion. That's it. So I always throw this, I threw this on there last week as well. My mortgage toolbox, if you do not have this app, either as a realtor or just a buyer or anybody in general, everybody should have this app on their phone. It does payments, stress tests. It does everything that you need to know about mortgages. It's got a refinance calculator, everything on it. So it's fantastic. That's it.
Amazing. Thank you, Ryan.
You're welcome.
Now we're going to hop off for questions, but if you're watching this webinar playback and you have questions, Ryan's contact info was at the beginning of this presentation. Alternatively, you can reach out to Kelly and I at Urban Haven Group and we'll put you in contact with Ryan. All right.